A lot of the folks that I've worked with over the years have been diligent about saving their money so that they could retire comfortably. But now that they're there, they have a difficult time transitioning from saving to spending. In this video, I'm going to talk about some of the ways that you can practically start spending your money and hopefully give you some tools to do that effectively. So let's say you're one of those people who has built up a significant nest egg and you're in a position that you can retire or you have recently retired, but you're having a difficult time actually spending your money. The first thing that I would encourage you to do is to take a step back and realize that the dollars you've set aside are going to end up in one of three places. Number one, you can spend them. Number two, you can gift them to someone during your lifetime. Or number three, you can hold them until you pass away and leave everything to someone at death. There are no other options. We're going to start with the first one. What does it look like to spend your money? One of the phrases that's used in our industry fairly often is that there's 3 goes of retirement. There's the go-go years, the slow-go years, and then the no-go years. The go-go period is when you first retire and now you have the time and money and health and you decide, you know what, I'm going to live it up, go take all of those trips that I've been wanting to do the upgrades in the house I've been wanting to do, so on and so forth. The slow go years is when you still want to do things, but sometimes health has started to catch up to you, and you just can't do all the things that you used to be able to do initially when you retired. Lastly, there's the no-go years, and those are the years where you may want to do things, but health is at a state where you just can't. My experience has supported this, and I see most of my clients spending more initially upon retirement, and then their spending tends to taper over time. Some of them do have significant end-of-life costs due to things like long-term care, but in terms of consumption, they tend to slowly decrease spending over time. I would encourage you, if you're at the beginning of your retirement, that you treat this as the go-go years. All the things that you've been wanting to do, but you haven't had the time to do or the finances to do, you're now in a position to do those things. Book the trip, buy the new car, treat yourself. Of course, do this within reason and know what the constraints are for your personal financial situation. But don't be so conservative that you never enjoy the dollars that you set aside. Now, there are plenty of people, when I tell them this, they say, you know, Kyle, there's genuinely nothing that we want that we don't have, or there's nothing that we want that's going to take a significant amount of cash. In that case, typically the conversation that we have is now there's only 2 outcomes for your money. Either you gift it during your lifetime, or you leave it to someone when you pass. So we're going to focus on number 2. What does it look like to gift money during your lifetime? This can be a difficult mental hurdle for clients to get over, to figure out who should I gift to and how much. The most common beneficiaries of gifts are children and grandchildren, and a close second would be charities of some type. For the sake of this video, I'm going to talk primarily about how to effectively gift dollars to your children. Most of the clients that I work with have the majority of their assets in tax-deferred investment accounts like traditional IRAs, 401ks, TSP. As you age, you will eventually have to start taking dollars out of these accounts due to the required minimum distribution rules. But should you leave behind a large nest egg from pre-tax accounts to a beneficiary, that beneficiary then has to distribute those dollars and pay the taxes at their ordinary income tax rate. In most cases, they will have 10 years to do so. If that is a $2 million IRA account and your child distributes the dollars evenly over a 10-year period, then they're going to have $200,000 of additional taxable income each year over that period, which has the potential to move them into a significantly higher tax bracket. Unfortunately, most of the times I see this happen, the children are in their peak earning years just before retirement, so they are already in a fairly high tax bracket themselves, and the additional income is only taxed that much higher of a rate. They cannot turn around and put all of those dollars into their own IRA because of the IRA and 401k contribution limits. That means if they want to keep those dollars invested, then they will have to put those dollars into a taxable brokerage account, which will generate additional interest, dividends, capital gain distributions. They'll realize capital gains along the way. Ultimately, the result is that less dollars stay in the family and more go to taxes over time. So here's a strategy that you can use to keep more dollars in the family and less dollars going to taxes. Instead of leaving all of your pre-tax assets to your children and grandchildren at death, what I would suggest is you consider gifting them during your children's working years so that they can take those dollars and make maximum contributions to their own IRAs or 401ks or TSPs or whatever their workplace retirement plan is. That way they can enjoy the tax privileges on those dollars for their lifetime and not just the 10 years following your death. This is one of the things that we talk about when we think of multi-generational financial planning. Another thing to consider is if someone is going to have to pay the taxes on those pre-tax assets, either you or your child or grandchild, we should consider who is in the lowest tax bracket or is expected to be in the lowest tax bracket at the time that those dollars are distributed. Now, this can be difficult to predict, but if there's a clear answer, for example, you're in a significantly higher tax bracket than your child, it may be worth leaving the dollars in that pre-tax account, passing it at death so that your child can then distribute those dollars at a lower tax rate. Another strategy that works well is gifting appreciated assets to your children or grandchildren, especially if they are in a lower capital gains tax bracket. I've seen people before take stocks out of their taxable brokerage account, sell them, and give the cash to kids or grandkids who are in a significantly lower capital gains tax bracket. Instead, a better approach may be to gift them the stock directly and allow them to sell it and realize the capital gains on their own tax return. This is still something to consider if you are planning on leaving Roth assets to a beneficiary as well. As a reminder, any type of IRA account is typically going to be emptied within 10 years following your death. So if you leave a Roth IRA to a beneficiary who's not your spouse, then in general, they'll only get to enjoy the tax-deferred or tax-free growth in that account for a 10-year period. So if that beneficiary is not already maxing out all of their Roth accounts, like their Roth IRA and Roth 401k, then it may be worth considering distributing dollars from your own Roth IRA to them so that they can max fund their own Roth accounts and enjoy those tax privileges for a much longer period of time than just the 10 years following your death. As a last note, sometimes I have clients who are concerned about their children's ability to manage money, and in that case, there are ways to gift dollars to children or other beneficiaries through trusts that limit either the amount or the reasons for which they can access those dollars. The strategies for gifting to charity are going to be a little bit different. Oftentimes we may employ things like charitable trusts or qualified charitable distributions or gifting appreciated taxable assets. I may make a video in the future focused more specifically on gifting to charity in order to effectively minimize your own taxation. So we talked about spending money during your retirement. We've talked about gifting money during your retirement. The third possible outcome for your dollars is that you leave them to someone at death. More often than not, when I talk to my clients about gifting money during their lifetime, they will tell me that they intend to spend all of their money and that they have no desire to leave a significant amount to beneficiaries. But if those clients have been retired for 2 or 3 years and they haven't substantially started spending money, then I'll tell them, hey, I know you said that you don't intend to leave a large nest egg to your children, but what you're doing is telling me that you are planning to do that. And if that is the case, then we may want to plan in a way, again, to keep as much money in the family as possible. So what are the most effective ways to leave dollars to beneficiaries? If your beneficiaries are in a significantly lower tax bracket than you, it may be fine to leave pre-tax assets to your beneficiary at death. Leaving Roth assets to beneficiaries doesn't carry any additional tax burden, so that's a strategy to think of as well. When we talk about taxable brokerage accounts or even things like property, there's important things to consider when leaving those at death. The primary idea is what's called a step-up in cost basis. The way it works is, let's say that you purchase a stock or a property for $100,000 and it's grown in value and it's now worth $400,000. If you were to sell it, you would realize a $300,000 taxable gain. which you would report and you would pay taxes on. If instead you left that same asset to a beneficiary when you pass away, it's as if they bought that property for whatever the fair market value was at the time of your death. So if it was worth $400,000 at the time of your death and they sold it the next day for $400,000, they would have no taxable gain. But if instead you had sold it the day before you passed away for $400,000, you would have a $300,000 taxable gain, and you would owe a good portion of taxes on the sale of that property. This is one of the common mistakes that I see folks make when they are gifting dollars to their children or grandchildren. They will sell assets that have large unrealized capital gains, and they will put themselves in a position where they owe a significant amount in taxes, when instead those assets could have been left at death and they would have been able to keep more money in the family by eliminating some of those capital gains. So we talked about spending money during your lifetime, gifting money during your lifetime, and leaving money to a beneficiary at death. None of this is advice, but I hope this gets you thinking about some of the things that you could be doing now that you are retired or soon to be retired, so that you can leverage the dollars that you've set aside, both for your benefit and for the benefit of people that you love or causes that you care about. I strongly recommend consulting with a financial advisor as you start pursuing gifting strategies, or if you're looking to increase your spending in retirement, to make sure that you do either in an efficient fashion. If this is you, what I would recommend is that you take some time and write down what are the things that you and or your spouse would like to spend money on, and put a projected date on when you might want to accomplish those things. The second thing I would recommend, if you're intending to gift dollars either to friends or family or charities, are write down who those are and some quick notes about their financial scenario. If you're not already, I would take this information to your advisor and have them project for you these expenses and these gifts to make sure that your personal financial plan is still adequately funded. But they should also help you identify how you can achieve these things most efficiently while mitigating taxes along the way. I hope this helps you spend the money that you've set aside for retirement in a way that both benefits you and the people that you love.